Liquidity is what keeps this fiat system afloat. Without constant and never-ending monetary injections, the markets will decline. Velocity is very important because of the way that they have designed this debt-based monetary system to constantly enrich the few at the expense of the many. Currency, as in current, must always flow and not remain stagnant, or the entire financial system comes to a halt. You came here for the truth, so let me unveil that for you. Today we're going to talk about liquidity, something that very few people understand, but when you do, you realize the risk and fragility that is apparent, okay? That's the first topic. Then I want to cover some other issues, so stay tuned. Jam-packed episode for you today. Liquidity crunch is the new bubble gripping credit investors. This article is out of Bloomberg, and what we are talking about here is an issue that a lot of people like to have their head in the sand about, but we need to cover the truth at the Money GPS, so that's what we're doing. From excess to scarcity, a liquidity crunch has climbed to the top of the credit market's wall of worry. Angst over vanishing liquidity is now the chief concern among credit buyers in Europe, according to the Bank of America's client survey. All right, so the issues that talked about is late cycle worries, European political risk, and sharp price moves this year, particularly in Italy, are feeding fears money managers will be unable to relinquish their positions in the next downturn. That's the concern, because you're able to buy and sell normally when conditions are just fine, but as soon as they become heated, as soon as there is this downturn that's occurring, you're not going to be able to get your money out, at least at the price you want it. There's a massive spread, and the liquidity certainly dries up. It's not the trade issues or an economic market correction that look to be keeping credit investors up at night. The concern is a more pervasive rush for the exit at some point in the future. Very important to think about the causes of all of the potential worries we see today. And then, when you want to be able to get out of that particular asset, liquidity becomes a very important issue. Without that liquidity, you've got nothing. You're holding something there in hopes that there will be a buyer, but you don't know what that buyer will give you at that moment. You make that assumption today based on this current price. This goes for any asset, particularly with paper assets. So think about that. Today it's priced at this amount. When things start getting a little bit heated, what's the value at that moment? We don't know. We make guesses based on that. But what the value will be based on, how you want to sell it is a different story. This is the chart that they had out of the Bank of America Merrill Lynch. I show you these all the time. Well, right here, high-grade investors on the left-hand side, on the right-hand side, high-yield investors. And you can see market liquidity evaporates, has become a huge concern. And this is something I've always been talking about. This is an important issue, yet you barely hear about it. Why? Because we're always focused on the bull market. We are always looking at their performance over a set number of years. They'll show you the charts that are very favorable to them when you go to your financial advisor. Look at this chart. Fantastic. And look, I'll show you from the year 1900. I'll show you from today. The market has gone up. Excellent. So if you put your money in now, you'll have more money tomorrow. Please give me your money. But it's a little bit more complicated than that, okay, Mr. Financial Advisor? Further along in the article, an otherwise healthy economic backdrop has been overshadowed by extreme moves that are haunting cross-asset investors. From Italian government obligations to commodity markets and even tech shares, illiquidity fears are rising. It's especially a concern in high-yield credit, where investors holding cash bonds can face steep penalties if they rush for the exit. Big issues that we need to focus on. These sort of moves are the basis of my concern about how little real liquidity there is in both directions and how fragile the current market structure can be. That's not me saying that, okay? That's a quote. Bank of America survey found that evaporating liquidity was the main worry for 22% of high-grade bond investors and 20% of investors in junk debt. In June, the bubbles were primary concerns for 18% and 30% respectively. Okay, so all I know is that this is an issue. As far as I'm concerned, I don't really care what the survey says, but it just gives me an idea as to where their head is at. Liquidity is always going to be something that I'm looking at. All right. And then another chart here, history of credit investors survey, biggest perceived risks. I like to cover these very often because it's important to see these surveys just to be able to get an insight as to where the big institutional investors are at. I don't necessarily change my mind based on what I see in this survey, but I just like to see it, and I like to bring that to you to give you those ideas as well. So there's been some definite changes that have occurred over the last couple of years, but liquidity is now on the top of the list. So to me, very important, and they're making this connection here. I believe the quantitative failure, which basically means not continuing to print money, is going to be a major issue, and I completely agree. That's the liquidity. That is the liquidity. All right, now we're going to switch gears for the video. If for some reason you are like there's some individuals out there who don't like when I switch topics, well, we're going to switch topics. So I want to thank you for joining me. So I'll see you on the next video. But if you just want some good information, I'll continue on. Historical length of recoveries and subsequent market declines. Just wanted to show you this. You could see where it has gone. What people don't understand is that so much of the bull market is erased in a short period of time. Now think about it like this. If you think, well, my stock has gone up by 100%, so if the market crashes by 50%, well, I'm going to do just fine. But it doesn't ever work like that, okay? Because if the stock market has risen 100%, when did you buy in, first of all? But also think that's 50% of the total market. Of the total. Okay? You didn't buy in from zero. Understand where it has came from, where it has gone, and then you could make those best judgments for yourself and your own portfolio. Okay? I'm not here to tell you anything. I just show you the facts. We calculate, this is Turkey, that further lira depreciation to around 7.1 versus the US dollar on average could largely erode the bank's excess capital. So we would have to see some major quantitative easing done by the Central Bank of Turkey in the event that it gets to around 7.1 to the US dollar. This is Goldman Sachs' prediction. I don't know if that's the case, but it is definitely weakening. The government is trying to do their best. However, this is always, in 100% of cases, trying to stabilize the currency only makes it worse. Looking at the US government here. Now, if you'll know anything about the way governments, agencies, and different departments work, it's that you literally need to spend more every single year. If you're given a budget of $1 million, you have to spend at least $1 million, or next year, you're not going to get that $1 million. You're going to get 800,000 or whatever it might be. So this is the way it works, and it works on the federal level as well. A combination of factors will see the federal agencies trying to spend as much as 40% of their budgets in the final 2 months of the fiscal year. So they're going to be buying a whole bunch of garbage they don't need, probably not employing enough people, but yet they're going to be spending a lot and enriching a few corporations in the process, all right? Federal agencies look to spend $140 billion more than they thought they'd get before Congress passed the omnibus spending bill. So here you go, you get some more spending, just do it, just spend it. 2 months left, just spend it all. Why not? Instead of being, a little bit more conservative with it, instead of being a little bit more smart with it, no, just burn it all. More taxpayer dollars going down the drain. Average earnings day moves are getting bigger. And we always see this right now, the earnings, everybody's waiting for the earnings. They're anticipating the earnings going on as if it's some sort of big deal, even though we've proved before over and over again that these numbers can easily be fraudulent. But hey, let's just have a reason to party. That's basically what it's all about. On the right hand side, earnings day moves so far this quarter are higher than the past 8 quarter moves. We got a lot of buybacks going on. We got a lot of quantitative easing going on. And quite frankly, this is simply a result of all of the garbage they've been putting into the system, ruining it. And they're just waiting for good news, waiting for bad news. It's not as if the fundamentals matter anymore. Top 10% wealth share in the US going back literally to the 30s, to the 1930s. That's how unequal things are today. Oh, this is the American dream or whatever. You hear all this nonsense. And meanwhile, they have been doing everything that they can to ensure that the bottom 90%, or in fact, I should say the bottom 99.99% get pushed further down. Okay, that's just the way it works. It's a matter of fact. Okay, now interconnected with that is this change in income inequality at the top and bottom of income distribution. You could see that on these charts for yourself. I'm just going to move on. One last article. Saudi is selling off its Canadian assets as row intensifies. This is a most ridiculous thing I've ever heard of. Oh, you criticized us? We're going to sell your assets. I mean, what a joke. What a piece of garbage this. I'm going to end it there. I'm frustrated. I'm frustrated by such. This is what like a 4-year-old child. Oh, you took my toy? Well, you can't have my toy. That's it. I'm running away now. I'm going to go hide in the corner. If you found the video informative, please give me a thumbs up. Last but not least, if you want the financial education that you were not taught in schools, these 2 books have it all. When you read these 2 books, you get everything you need to know to be able to take care of your own finances. You don't need to rely on a financial advisor any longer. But if you do, you can at least ask the right questions. So these 2 books fit into each other like puzzle pieces. They really fill in the gaps for each other. So there's not one or the other, but really both together. You can check them out at the link in the description of this video if you're more interested in the audiobook version. That's available at themoneygps.com.